Hi everyone, and welcome back to my Canadian finance channel, where every week is something completely random and unrelated to the topic before. I think a month ago I was talking about options trading. Last month was financial advice for newlyweds that nobody watched, apparently. And this week I'll be ranting about the top investing mistakes or items you should avoid while investing. As we're just finishing up the tax season and everyone is getting refunds or putting money into their RSP, I'm noticing huge mistakes from my friends or even big mistakes from the viewers of my channel that are sending me messages. Before we get started, I've made a free ebook breaking down some Canadian finance and investing topics for beginners if you're interested. I'll leave a link if you want to sign up for some freebies, and then obviously I'll use your email to market my Canadian finance course that includes a one-on-one Zoom chat. If you're interested, please subscribe to the channel or like the video. I've noticed 80 or 90% of my viewers aren't subscribing, so maybe if I say it more, they'll actually do it. Number one, not having a clear investment plan. Why would you camp without a compass? Or I've never been camping. Regardless, you should have a general outline of your financial goals. Are you saving for retirement, saving for a down payment on a house, or are you saving for an emergency fund? Answering these questions lets me know about your risk tolerance and your time horizon. Retirement ideally is 15 plus years away. House down payment is 3 or 4 years away. Emergency fund could be 1 year or so. Retirement investing means you can go risky in terms of investing. And by risky, I mean purchasing growth stocks instead of dividend stocks, or even instead of purchasing fixed income items like a GIC. The latter items provide low and safe returns, which is fine, but you want those when you're actually retired. My advice when you're 20 or 30 years away from potentially retiring, I recommend growth-oriented ETFs that include Apple, Google, Meta, Nvidia, so your portfolio can triple or quadruple by the time you're ready to live off of it. If you want an easy and straightforward guide on stocks to buy in 2024, I've made this video for you, the top 3 ETFs for 2024. If you're interested in saving for a house down payment, you don't want much risk in the short term because you'll need those funds and you'll need to count on how much cash you actually have. I wouldn't recommend stocks. If you're investing your house down payment, I would recommend fixed or guaranteed income like a GIC. Ideally, I would lock in a GIC for a year, meaning non-cashable. If you get a locked-in GIC, you can't withdraw it for a certain amount of time. Normally, it's 1 year. By locking it in, you would normally get a higher rate. You normally get a higher rate, meaning more money. If you choose a cashable GIC, it means you could pull out at any time. Having this flexibility means you have to accept a lower rate of return and you earn less. If you're investing for an emergency fund, I wouldn't really call it investing, but you can choose a high-yield savings account like the Wealthsimple savings account. Like any bank you store your money in, you can get a savings account. Ideally, that money needs to be readily available, not locked in a GIC or anything. It's for emergency, so I would try to find a 3 or 4% savings account, which is easy to find in 2024, so at least your money is keeping up with inflation. Number 2, ignoring fees. Investment fees can significantly impact your returns over time. This includes management expense ratios, MERs, for mutual funds and ETFs. Transaction fees, and even buying and selling stocks, any account maintenance, hopefully none. Many Canadians have been advocating for more transparency in investing fees so investors can make more informed decisions. The banks and investment advisors are so shady, they rarely tell you the big picture and are almost always getting kickbacks from what they tell you to invest in. I don't think I've ever found a mutual fund recommended by a bank that I would recommend for a friend or anyone watching this to buy or invest in. The fees are so high. The banks always try to take advantage of you by telling you how good the returns are and telling you how good the investment is. They almost always show you the returns before their fees. It's so devious. An example, they'll say the returns are 10% a year, which is good. But what they don't tell you is that's before their fee of 2.5%, which is bad. Here's the kicker. Even if the fund loses 10% a year, they're still taking the 2.5% management fee. It's so devious. For the past 4 years of this channel, I've done the work for you. My investment recommendation videos almost always focus on low-cost investment, low-cost index funds, and ETFs. They can be a good choice for the cost-conscious investors. Again, the ETFs I recommend in this video or in any videos are almost always low cost, except the Bitcoin ones or the covered call ones, which are on the higher end. I think like 0.7 was the highest I've recommended, which is bad, but still, if they could do the work for you and provide above average returns, I think it'll pay off. Number 3, emotional investing. Emotional investing refers to making buy or sell decisions based on market conditions or personal feelings rather than sticking to a long-term investment strategy. The danger here is reacting impulsively to short-term market volatility, which can lead to selling during downturns and then buying during upswings because you don't want to miss the boat. I've been guilty of it in the past. The Bank of Canada's research indicates that investors who keep a long-term perspective and avoid making impulse-based decisions just based on market news tend to achieve better financial outcomes. Here's an example. Right now, markets are near all-time highs. They've never been higher. You could just use this indicator to judge for yourself. Go into Google, type SPY stock. It's been shooting up rapidly over the last year and even more so in the last few months. The scared side of me says, this is too high, we're in a bubble, the stocks have to come down, let me sell now and buy back when it dips. The issue is, I thought stocks were too high last year, so if I sold last year, I would have missed out on a 30% upside. I thought stocks were too high 6 months ago. If I sold, I would have missed out on 22%. The key here is don't try to time the market, just buy and hold for the long term. This example is stocks being too high. Let's look at the other side. What if stocks are dropping? During the March 2020 crash, I made a video about how I was down $100,000 in just 3 weeks. Everyone thought the world was over, everyone was selling their stocks and everything was dropping. One side of me was saying, hey, sell now and buy back at a lower cost and make all your money back when it recovers. The issue is, how do I know when the bottom is? How do I know when stocks are done dropping? Again, the strategy is to buy and hold through all these market fluctuations. And you know what's crazy? I held all my stocks. I was down $100,000, and then within 6 months, everything came back and I was breaking even. And then 6 months after that, I was actually up over $50,000 just by doing nothing and thinking of the long term. Don't try to time the market or predict the market unless you follow Nancy Pelosi's trades. She seems to have a crystal ball about investments, and I just can't put my finger on quite how she does it. Number 4, overlooking diversification. Diversification is the practice of spreading your investments across various asset classes like stocks, bonds, real estate, and crypto, and even within asset classes across different industries, sectors, and geographies to reduce risk. The idea is that not all investments will perform poorly at the same time, and by diversifying, you can mitigate losses, which is great. You don't want to be all investing in one stock like Apple. Even though it has been doing well, it's a risk. You don't want to be all invested in Canada or all in the US. Of course, there are stories of someone who only bought Nvidia. Okay, congrats, they got lucky, but that's just selectively choosing the winners. The chances are you would pick a loser. What if you were all invested in Bumble, that dumpster fire of a company? You'd be down 85%, likely never to recover. What if you invested in Snapchat, another dumpster fire? You'd be down 55%, also likely to never recover, but more likely than Bumble. Maybe I'll make a rant video about that. I feel like the CEO should be sued for deception, but let's not get into it. They always get away with it. Number 5, lump sum investing. To be honest, this could be added to the previous one about emotional investing, but I was talking about timing the market in a way. A recent investor said they don't want to invest unless they have at least $10,000 to invest, and I see this a lot, which I don't understand. Market timing involves attempting to predict the market highs and lows and making buy or sell decisions based on those predictions. However, numerous studies, including the ones referenced by the CPPIB, Canada Pension Plan Investment Board, struggling to talk, even they say investors struggle to time the market consistently. A better approach is to invest regularly regardless of market conditions, a strategy known as dollar cost averaging. This method helps investors buy more when shares are high, and helps investors buy more shares when prices are low and fewer shares when prices are high, potentially lowering the average cost per share over time. I never understood when someone comments on my video and they say they don't have enough to invest. Yes, you do. If you have a spare $500 or any spare cash, like if I go through your Visa statement and I see vacations, trips, or new clothes that you don't need, or even a new phone that you certainly don't need, you certainly have money to invest. Even if it's $500, start now, it'll grow and you'll be happy you did. That's it for this video. Thanks for watching and tune into the next one.